Hello and welcome. This is June Collier from Make Your Money Work for You. Congratulations on making it to week number 5, Dividend Investing. In this lesson, you will discover how safe dividend investing can be if done correctly. The goal of this course is to teach you how to create income without selling your stocks through dividend investing. Now, what is a dividend? A dividend is a distribution of some of a company's earnings back to its shareholders. Successful corporations generate surplus cash that they don't need for expansion or to repay bank loans. These surplus cash flows are sometimes called free cash flows. Shareholders own that surplus cash and receive it in the form of what is known as dividends. These dividends are paid to the shareholders in proportion to the number of shares that they own. Now, why dividend investing? Dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income from your investments. This income is in addition to any growth your portfolio experiences as the stock in it gains value. Dividend investing can be an excellent way to generate income and grow your investment portfolio over a long period of time. By focusing on solid companies that increase their dividends regularly, a small sum of money could turn into a large nest egg thanks to compounded gains. Dividend investing represents the safest method to actually get paid for owning a stock. The goal is to generate cash flow to replace all of your living expenses. Now, there are a couple important dividend dates that you will want to know about if you're going to be a dividend investor. Companies report earnings quarterly and decide if dividends will be paid to shareholders, and if so, how much. This is called the declaration date. Next, you must be a shareholder of the stock by X dividend date to qualify for the dividend payout. This is the last day that you can purchase the stock and qualify to receive a dividend. The record date is the date the company will compile the list of qualified shareholders and then pay them on the payment date. On the payment date, you pay those shareholders their dividend according to the number of shares they have multiplied by the dividend amount. Dividend-paying companies. Good companies make a strong effort to keep consistent, slow-rising dividends. A stable dividend cash flow stream gives the shareholders and potential shareholders the impression of stability. Companies that pay cash dividends tend to pay steady dividends that almost never decrease and that are increased only slowly and cautiously to make sure that an increased level of dividends can be maintained in the future. Now, the bar is set for dividend royalty. It's set very high. Companies must increase their dividends each year for the number of years listed. There have been some tough years, including the 2008 to 2010 Great Recession, as well as the 2001 dot-com bust, and now the pandemic era of 2020. There are 3 dividend royalties. First is Dividend Kings. These are S&P 500 companies that have increased their dividends every year for 50 years straight. Then there's the Dividend Aristocrats. These are S&P 500 companies that have increased their dividends every year for 25 years straight. Finally, Dividend Champions. These are companies that are not necessarily in the S&P 500, but have increased their dividends every year for 25 years straight. How to pick a dividend stock. What you're looking for is consistent profits and cash flow. In order for a company to pay dividends, they should have consistent profits and cash flow. You also are looking for steady increase of dividends. Look for an increase in dividends year over year. Dividend yield of 2 to 5%. A strong dividend yield can produce excellent dividends. More cash than debt. You want a company that has enough cash on hand that it can cover its debts and pay dividends. Paid their dividends for more than 20 years. These are companies that survived the dot-com 2000 crash and the financial crash of 2008. If the company has been able to consistently and increasingly pay dividends over the last 20 years, that says a lot. And then finally, the payout ratio. This is the proportion of earnings a company pays shareholders in the form of dividends, expressed as a percentage of the company's total earnings. The payout ratio refers to the dividends paid out as a percentage of a company's cash flow. Dividend Reinvestment Plan. A dividend reinvestment plan, also known as a DRIP, is a program that allows investors to reinvest their cash dividends into additional shares or fractional shares of the underlying stock on the dividend payment date. Many companies offer shares at a discount through their DRIP from 1 to 10% off the current share price. Through DRIPs, investor can also buy fractional shares, so every dividend dollar is really going to work. Although the shareholder does not actually receive the reinvested dividends, they still need to be reported as taxable income, unless they're held in a tax advantage account like an IRA. The Coca-Cola DRIP. If a shareholder were to have invested $10,000 in mid-June of 1962 and held through mid-June of 2012, a period of 50 years, what results would have been experienced? Well, if the dividends were not invested, that investor would have received $136,000 in cash dividends, and the portfolio value would be $503,102.88. However, if the dividends were reinvested, the value of the portfolio would be $1,748,879.15. The real truth about dividend yields. When you first start dividend investing, it may not seem like a lot, especially if a company is paying out 2% to 3% dividend yields. It may not seem like a lot of money for the investment cost. However, the secret is in the stock price increasing over time, as well as stock splits. In this example, we purchased AT&T for $30.01 on March 18, 2021. This stock pays an impressive 6.9 dividend yield. Let's assume that we hold the stock and the stock appreciates to $40 1 year from now. If the stock continued to pay a 6.9% dividend at $40, the dividend amount would be $2.76. But because we bought the stock for $30.01 a year earlier, instead of getting a 6.9% return, we would actually have a 9.2% dividend yield. Resources. Here are a couple of dividend resources that you may want to check out. www.dividend.com. We also have www.marketbeat.com/dividends/calculator. We also have www.dividendinvestor.com. And finally, www.dividenddetective.com. Well, congratulations. You've successfully completed week number 5, dividend investing.